Welcome back to Market on Close. About 10 minutes from the closing bell, and it's time for the big picture. Joining me now is Chief Investment Strategist for Charles Schwab, Ann Sonders, to help make some sense of it all. Ann, good afternoon. Big day today in terms of economic data. I know you and your team monitor this stuff very closely. What did we learn, and how did it change, if it did, the picture going forward?
Well, it may be a little bit of a sign of some catch down by the hard data to the soft data. The soft data being survey-based, consumer confidence, CEO confidence, that's been quite depressed. And with retail sales, it was on the lighter side, in particular, the control group portion of retail sales, which is what feeds into GDP. And you saw also some weakness in Empire, in Philly Fed, maybe not to the degree that was expected, but even the PPI softness, I think, is a function of some slower economic growth. So nothing terribly disastrous yet. And we think that actually we might see a bit of a convergence in the hard and soft data, a little bit of a weakening in the hard data, maybe some improvement in the soft data, but kind of a mixed bag.
And obviously noisy, I imagine, too, with all the stuff going on the trade front. We seem to have staved off maybe the worst of a potential embargo-like tariff level with China, but still a lot of unanswered questions on that front. Where do you assess sort of the impact of the uncertainty of trade at this moment?
We're still going to be, and the markets are going to be at the mercy of the headlines. Quite frankly, if what we know right now to be tariffs either in place or proposed was announced, notwithstanding the delays, on April 2nd, I think it would have been something that the market and its participants would have to digest, and you would have already seen probably some downward estimates to growth forecasts. I think we're in an interesting point here, though, because we've seen some of the economic data get skewed by virtue of a lot of the tariff front running. So a lot of buildup of inventories, and maybe now we're at that point where companies are trying to play around with pricing to see what sticks. But from a more general perspective, I think before this de-escalation, at least as it relates to China, if you had either pulled your forward guidance to analysts covering your stock, or you had held off on or announced a holding off on CapEx, long-term investment plans, I'm not sure the de-escalation answers those uncertainties and triggers companies to say, all right, now we know the playing field. Let's reignite capital spending. Let's provide guidance again. I think we're still very murky.
All that said, we're basically back now to nearly 6,000 in the S&Ps, at least futures. I know cash closed just over 5,900. Incredible how far we've come in such a small amount of time. I see in your notes you kind of talk about the areas of the market that have led, and we know very, very publicly many have doubted the comeback. You obviously just covered a lot of the reasons why maybe we're not in the clear just yet, but has enough market performance I guess, healed some of those concerns for investors who maybe jumped out? Are they going to be jumping back in now?
So here's how I think about it. With the benefit of hindsight, we're all brilliant armchair quarterbacks. But I think at the April 8th or intraday April 9th lows, you probably had the market having overshot on the downside, at least as it relates to a discounting mechanism for where near-term economic growth was likely to unfold. Now maybe we might be getting to the point where we've overshot on the upside in terms of kind of nothing to see here. We can write off recession risk. But that's the nature of markets. It is first of all, it's an interesting market day to day to have an up day, at least in the case of the S&P 500, but led by the defensive areas like staples and utilities, and the growth trio of tech, comm services, and consumer discretionary being at the bottom of the leaderboard. So that's in contrast to what sort of led most of the rally on the upside, which was in those more traditional retail favorites of, Mag 7 and AI adjacent kind of names. So I continue to think we're gonna see a lot of sector oriented volatility, very difficult to trade around kind of some of those sector moves.
Yeah, so this will tie into my next question really nicely, which ultimately will go to where you see all of this potentially going for the rest of the year. But let's just compare and contrast yesterday and today. They're basically the exact opposite days. Yesterday we had the same tug of war but it was all the stuff that's working today wasn't working yesterday, and we were led by the AI and semiconductors. Right. But both times we had a green market. So it just seems like whatever the market's cooking up right now is leading to the S&Ps in the green. Do you think that's sustainable, or are we, like you said, maybe running a little bit long in the tooth here?
So I think it's going to continue to be a choppy kind of market. And even if the uptrend continues, and it probably does have some more legs, I'm not sure there's going to be persistence in terms of sector leadership. It's one of the reasons why, as you probably know, a month or so ago, I think it was actually in the beginning of April, we neutralized all of our sector ratings, where normally we would have outperform or underperform or market perform, the latter being neutral, to use generic terms. We neutralized everything. The only other time we've done that was back in the early part of the pandemic, when it was just impossible to try to trade around these really short-term sector leadership biases. I think that kind of market backdrop is likely to persist, at least in the near term.
Liz Ann, final question then. I think this echoes obviously the same sentiment the Fed has, which is a sidelines, wait and see, react as it happens, understanding that you're not going to be the first mover, but you're more likely to be on the right track. What are you guys waiting for? What do you want to see before you feel a little bit more confident to maybe lean one way or another when it comes to some of these sectors or some of these factors that you guys look at?
We probably need to see some stabilization in the forward-looking outlook. We're at, I think, 20 consecutive weeks now of downward revisions to 2025 numbers. And that's in spite of the fact that first quarter reporting season was incredibly strong, 14%, but that was not extrapolated into the rest of the year. So prices having come down during the correction, bear market in the case of the NASDAQ, did help to improve the valuation backdrop. The problem was that not just the P, the numerator was coming down, but the denominator was moving down too. And I think we'd need to see at least some stability, if not a clearer outlook, to get a sense of what the denominator in the equation is. I'm not sure we're going to get that in the near term, but that would certainly be something to keep an eye on, because then you start to see a more stable valuation backdrop.
Well, we'll look forward to the day that does happen. Liz Ann Sonders, it's always a pleasure, and thanks so much for taking the time. The Chief Investment Strategist for Charles Schwab.